What if I told you that while your stock portfolio was bleeding red this morning, while the Dow futures were crashing 500 points, while the S&P 500 was selling off hard, while oil was exploding past $114 a barrel, there was one asset that has been quietly telling you the truth about the economy this entire time, and that asset is gold. Here's what's happening right now on the morning of March 9th, 2026. Gold is trading at approximately $5,100 per ounce. Silver is holding near $83 to $84 per ounce. And just a few weeks ago, in January, gold hit an all-time record high of $5,608.35 per ounce. Let me put that in perspective. Gold crossed $5,000 for the very first time in history just this year. In the first 26 days of 2026 alone, gold jumped 15%. And right now, gold is up nearly 20% year to date, while the stock market is basically flat or negative. But here's the part that should make every American pay attention. Every major bank on Wall Street is now calling for $6,000 gold. UBS says $6,200 by June. Deutsche Bank says $6,000, Bank of America says $6,000, Societe Generale says $6,000, and with oil at $114 a barrel, a war in the Middle East, stagflation fears rising, and the Federal Reserve trapped between a rock and a hard place, the conditions that got gold to $5,600 haven't gone away. They've gotten worse. Today we're going to break down exactly what is driving gold and silver right now, what the economy is really telling us, what the smart money is doing, and most importantly, what you should understand about all of this. Let's go. To understand gold today, you need to understand the macro backdrop, and it is one of the most complex and scary environments we have seen in years. First, the Iran War. The United States and Israel launched military operations against Iran, and the conflict has been escalating since late February 2026. Here is the direct economic consequence. Iran sits at the edge of the Strait of Hormuz, the narrow waterway through which roughly 20% of the world's entire oil supply travels every single day. The war has already led to the suspension of nearly 1/5 of global crude oil production and natural gas supply, and as a result, oil prices have absolutely exploded. As of this morning, Brent crude oil is trading above $114 a barrel, with reports of brief spikes near $120 overnight. That is a 25% spike in oil prices since the conflict began. CNBC's Jim Cramer warned this weekend that oil could surge to $150 to $200 a barrel in a worst-case scenario. Goldman Sachs says the market is pricing about a 4-week conflict, but if the war drags on longer, markets haven't priced that in yet. Second, stagflation fears. Here is the economic nightmare scenario. Oil at $114 means gasoline prices spike. Gasoline prices spiking means inflation surges. But at the same time, a war-disrupting trade and energy supply means economic growth slows down. That combination, rising inflation plus slowing growth, is called stagflation. And it is the single worst economic scenario for traditional investments like stocks and bonds. The last time America experienced true stagflation was the 1970s. And you know what asset crushed everything in the 1970s? Gold. Third, the Federal Reserve is trapped. Right now, the Fed funds rate sits at roughly 3.5% to 3.75%. The Fed wants to keep inflation in check, but it also doesn't want to choke off a slowing economy with higher rates. If oil stays at 114, inflation data in the coming weeks will almost certainly come in red hot. That could force the Fed's hand in a direction nobody on Wall Street wants. And every time investors sense the Fed is losing control of the inflation narrative, gold surges. Here's the wild part. Gold is already at $5,100 an ounce with the Fed still keeping rates elevated. Gold is supposed to struggle when interest rates are high, because high rates mean you can earn return on cash, making a non-yielding asset like gold less attractive. But gold is completely defying that logic right now. As one analyst put it, $5,000 gold in the face of a 3.75% Fed funds rate is a clear signal that the market's trust in traditional monetary policy is eroding. Let me walk you through the remarkable journey gold has been on in 2026 because the timeline tells you everything. January 2026, gold enters the year on a historic run. In the first 26 days alone, the price jumps 15% and blows through the $5,000 per ounce barrier for the first time in history. CNBC headlines screamed it, CNN covered it, every financial news outlet was talking about it. Gold crossed $5,100, then $5,200, then $5,300. Late January 2026, gold hits its all-time record high of $5,608.35 per ounce. Think about what that means. Just a few years ago, gold was around $1,800 an ounce. In 2020, during COVID, it hit $2,000 for the first time, and people were stunned. In 2024, it crossed $3,000. By 2025, it hit $4,000. And now we're sitting at $5,100, having touched $5,608 just weeks ago. The pullback. After hitting $5,608, gold corrected. That's normal and healthy. In fact, it's classic bull market behavior. 2 steps forward, 1 step back. Gold pulled back toward the $5,000 area as some investors took profits. Early March 2026, the Iran war begins. Gold initially surges back toward $5,400 as investors pile into the classic safe haven trade. But then something interesting happens. Gold partially gives back those gains, settling in the $5,091 to $5,172 range where it sits today. Why? Because the US dollar also strengthened as investors globally bought dollars as a safe haven, and a stronger dollar traditionally weighs on dollar-denominated gold prices. Also, bond yields spiked as inflation fears rose, creating some short-term headwinds. So where does gold sit today on March 9th? Approximately $5,091 to $5,105 per ounce, up about 19% year-to-date. For context, the stock market, the S&P 500, is basically flat. The Vanguard Total Stock Market ETF, VTI, is down about 1.15% year-to-date. Gold is beating the entire U.S. stock market by nearly 20 percentage points in just over 2 months of 2026. Now let's talk about silver, because this is where things get really interesting. Silver is the metal that most people overlook. Gold gets all the headlines, but silver might be the biggest opportunity in the entire precious metals space right now. Here are today's numbers. Silver is trading at approximately $83 to $84 per ounce this morning. Just a few days ago, silver jumped strongly as Middle East tensions intensified. But here's the bigger story. Silver surged 147% in 2025. Gold gained about 67% in 2025. Silver nearly doubled gold's performance. And now in 2026, silver is holding strong around $83 to $84 while people are asking, can silver hit $200? Let me give you the bull case and the honest reality. Silver has dual demand. It's both a precious metal and an industrial metal. Roughly half of silver demand comes from industrial applications: solar panels, electric vehicles, semiconductors, medical devices, and communication infrastructure. The global green energy transition is structurally increasing silver demand every year. Meanwhile, silver supply from mining is struggling to keep up. If gold is heading to $6,000 and the gold-to-silver ratio historically normalizes, silver at $100 or even $150 per ounce is not unrealistic. But the base case forecasts from major banks are more conservative. Some analysts expect silver to average around $81 in 2026, while others see potential ranges stretching well above $100 if the bull cycle accelerates. Here's something many investors overlook: the gold-to-silver ratio. This ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, the ratio sits around 60 to 61. Historically, when this ratio is extremely high, silver tends to outperform gold later as the ratio compresses. When the ratio is very low, gold tends to outperform. At around 60, we're in a middle range, but silver has been gradually closing the gap. Now here's the story that most mainstream financial media is not emphasizing enough. And it's one of the most powerful forces driving gold's bull market. Central banks around the world are buying gold at record pace. China's central bank has been adding gold to its reserves month after month. Nations are increasingly shifting part of their reserves away from traditional currency holdings and into physical gold. Global gold demand reached record levels in recent years, with central banks responsible for a huge portion of that buying. Think about what this means. When the largest institutions on Earth, governments, central banks, sovereign wealth funds, are quietly accumulating gold, they are signaling something profound about their expectations for the global financial system. Gold has no counterparty risk. It cannot be printed. It cannot be frozen electronically in the same way financial assets can. It has served as a store of value for thousands of years. That structural demand is one of the core reasons analysts believe the long-term gold trend is still upward. Now let's talk about the $6,000 gold prediction, because this call is not coming from social media speculation. It is coming from major financial institutions with large research teams. Multiple global banks have issued forecasts placing gold around the $6,000 level during this cycle. These projections are based on macroeconomic modeling, central bank demand trends, inflation expectations, currency movements, and geopolitical risk premiums. For investors who want exposure through the stock market, 2 common vehicles exist. GLD, the SPDR Gold Shares ETF, tracks the price of gold directly and is one of the most widely traded gold ETFs. GDX, the VanEck Gold Miners ETF, holds shares of major gold mining companies. Mining companies can move faster than gold itself because their profits expand dramatically when the metal price rises. However, miners also carry additional risks such as operational challenges, management decisions, and geopolitical exposure. Let me step back from the charts for a moment and talk about what gold might be signaling about the broader economy. Surveys show that many people feel economically uncertain right now. Rising energy costs, persistent inflation concerns, and market volatility are all contributing to that sentiment. Gold often rises during periods when investors seek stability and protection against uncertainty. When gold rises while other assets struggle, it can indicate that investors are shifting part of their capital toward assets perceived as stores of value. That does not mean the financial system is collapsing, but it does signal that markets are adjusting to new risks. So what does all of this mean for you as an investor? First, understand what gold actually represents. Gold is not designed to generate income like stocks or bonds. Instead, it acts as a form of monetary insurance, a way to preserve purchasing power during uncertain periods. Some investors choose to allocate a portion of their portfolios to precious metals as part of diversification. Exposure can come through physical metals, ETFs that track the price of gold, or mining companies that benefit from rising metal prices. Silver offers another dimension because it combines monetary demand with industrial demand, though it is typically more volatile than gold. The key idea is balance. Diversification across different asset types can help investors manage risk during periods when markets become unpredictable. At the same time, it is important not to chase any asset blindly. Markets move in cycles, and maintaining discipline is critical. Here's the big picture. We are living through a period of rapid economic and geopolitical change. Energy markets are volatile. Central banks are navigating difficult policy decisions. Investors are adjusting portfolios in response to uncertainty. Gold's rise is one signal among many about how markets are interpreting these changes. Understanding those signals can help investors make more informed decisions about risk, diversification, and long-term strategy. Stay informed, stay disciplined, and continue learning about the forces shaping the global financial system. Disclaimer: this video is for educational and informational purposes only and does not constitute financial, investment, tax, or legal advice. Investing in gold, silver, ETFs, or any other financial instrument involves risk, including the potential loss of capital. Always conduct your own research and consult a qualified financial professional before making investment decisions.